Welcome to Module 2 of Week 6, Qualified Retained Interest Trust. Of all the things that I do in estate planning today, this is an area that's most different from when I started doing estate planning and estate taxation many years ago. For many years, it was illegal from a tax standpoint for an individual to retain an interest in a product and give it away to get on a gift tax and get it out of their estate. And a typical example, because I saw a lot of it, is individual would find a stock that pays a dividend, like General Electric or Southern California Edison, would give the stock to their children or to their spouse and retain an interest in the dividends. So they would get dividends for the rest of their life, and at death they had no more interest in it because they had already gifted it 5-10 years earlier, the GE stock, and therefore they got the stock out of the estate, but were able to retain that income of those dividends. That is not tax favorable today. The entire value would be included in your estate today. However, the government does allow for certain retained interest, and the thing for you to do is be clear as to what retained interest they allow and which ones they don't. I might note that that simple method I just talked about, which was probably a one sheet of paper type, today is very complicated and many times requires appraisals and people who do property management, etc. So one of the things that we always consider or have to consider when we're talking about retained interest trust is what's the cost going to be for the client over the time period of the trust. Okay, let's take a look. Under today's tax rules, the right to transfer an asset and retain an interest without penalty is relatively limited. And the ones we can do today are what's called the grantor retained annuity trust, the grantor retained unit trust, and the qualified personal residence trust. All of those that used to be used that lawyers created for many years are no longer tax advantage, and you will have the entire value of the assets included in your estate. And the one I give you an example of, the GE, was called a grantor retained income trust. The grantor retained the income, the dividends, and the family member got the gifting of the asset itself, the corpus, the trust. Well, that's not tax advantage anymore. That would go into the estate. These do provide tax advantage, and we'll go through them right now. The first one we're going to discuss again is the one I brought before. The extremely popular GRIT is now treated so that the retained interest is being valued at zero for family member transfers, which means the entire value is going to be included in the estate. Consequence of the entire value of the GRIT is a gift for family members, which is the worst case to be in. I get a gift and it goes into my estate. So remember that. And it goes into your estate. Why? Because you're getting income till the date of death, and that's one of those big 10 we had that we discussed in week 3. So you get the gift tax. You get credit for the gift tax when you fill out your estate tax return, however. That makes any help. The grantor retained annuity trust. The grantor transfers assets to an irrevocable trust. It sets up an annuity for a stated number of years. The present value of the annuity is subtracted from the total value of assets transferred to the trust to calculate the remainder interest, in other words, the amount of the gift. Again, we need to use the IRS tables to determine the value of that gift, and it is fairly straightforward. It's going to be $50,000 a year or $10,000 a year. In some years, you may have to take some out of the corpus. In some years, you're going to have excess interest that you can put into the corpus. Relatively simple, but again, one of the problems is if you're talking a period of, say, 10 or 15 years, inflation drastically reduces that value of the annuity each year. And the purpose that people use these for is to get the value out of their estate but still have an income. Well, your income decreases each year, so not probably the best unless, again, you assume that you can keep inflation down. More popular in many respects because it does consider inflation, but also much more expensive is the GRUT, Grantor Retained Unit Trust. Instead of getting an annuity, the retained interest is a percentage of the assets. So each year We look at the assets using the trust percentage. Let's say it's 4%. Each year we get 4% of the assets of the trust that are paid out to the grantor. Again, the advantage of this trust is that much of the value of the assets gets transferred as a gift today at today's gift rates and gets it out of the estate. The problems are, first of all, you must yearly determine the value. So if it's something straightforward like all IBM stock, no problem. But let's say there's a real estate involved, or there is a business that is not on an exchange or raw land, you're going to have an appraisal made. Sometimes you have to have several appraisals made. And that's something I would say that is a big advantage, is that we can add to a GRUT over time. So where a GRAT, once you set it up, if you want to later set up another GRAT because you got some more money that you want to get out of your estate, you're going to have to set a separate GRAT. So you could wind up 10, 15, 20 different GRATs. But a GRUT can be one document by adding to the GRUT, and that helps. And it does provide inflation protection, as we mentioned before. The Qualified Personal Residence Trust, grantor transfers the residence to an irrevocable trust and retains the right to live in it for a fixed number of years. At the end of the period, the beneficiary's future interest gets full title. And if the grantor dies during the term of the trust, the fair market value of their estate will be included in the grantor's estate. Now, this is not as favorable as the Qualified Personal Residence Trust for charities that we'll be discussing later in the course. And one of the things people do confuse on the estate tax return is the rules for the grantor to a family member or a friend versus that to a charity. This is the rules related to the family member. It's a case where we get the asset out of the trust because you can only live there for a fixed number of years. If you die during that fixed number of years, it's going to go, the entire value of the house goes in the estate, so you want to need a relatively short period of time. At the end of that time period, you cannot live in the house unless you pay rent. And again, because of tax laws, you have to make sure the rent is arm's length transaction rent. Tangible person property trust. This is usually not covered in textbooks, but has become very popular the last few years with the value of a lot of collectibles and antiques, etc., becoming relatively high. And so it becomes an interest that might be interesting to talk about for a minute. It's come up with by lawyers, and it is qualified. It's similar to the personal residence trust, except it involves personal property. Again, it could be artwork, it could be paintings, it could be any antiques. It could also be, for example, a Rolex watch. Grantor retains the right to use the personal property as an annuity interest, and if the grantor dies during the annuity period, the fair market value goes in the estate. So what you got to do again is outlive that period. But then again, when you outlive the period, you lose the asset at the end of the period. So, but it does allow to get out of your estate at a very attractive price. Family limited partnerships, or flips, very, very popular. IRS has cut back some of it recently because they're tightening the rules, but it's a limited partnership used to transfer assets to younger generations using valuation techniques. And again, we use a minority interest and a lack of marketability interest, and can transfer a lot over a period of time, and has been successfully used for generations since we really came up with estate tax as a method of transferring to the next generation. And you're making use of the annual exclusion is probably the biggest advantage, because using the annual exclusion, especially if it's a husband and wife, so they can double the value of the annual exclusion, means you can give away a significant amount over a several-year period, especially if you're giving it away to 3 or 4 members of next generation. And if you're including grandchildren in here, and you're keeping it under the annual exclusion, you could ground the generation skipping tax and transfer a lot of assets to them. So it's a big consideration for anybody who has children or grandchildren and want to come up with passing on business interest. Again, these are designed for business interested, and most of the benefits that we talk about are designed for business interest, and that's something you should always get together with a client. Is they're worthwhile to form businesses, and quite frankly, if you look at wealthy people, they tend to be people who started a business, and you don't have to be starting a big business. You don't have to have an IBM. You can have a small local retail business or a small local service business and have tremendous value built up in a relatively short time period. And there's a lot of tax advantages associated with it. So with many of my clients over the years, I've encouraged people to start businesses either on a part-time basis and see how it works. And for some people, it work great. Some people, it's a disaster. And also thinking of also having it for more long-term and having it grow so that you can become a full-time employee. And then there's also some people who quit working for other people and start their own business. And that is, I would say, is very common once the children leave the house. So with that, that's the end of this session.